help you pick the right stock at the right time.
Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. These are the top headlines that we're tracking at this hour. Markets are up for the 6th day in a row. The Nifty trades above the 10,450 mark now. IT stocks lead the gains while metal stocks continue to see some profit booking in trade. Oil marketing companies are among the top losers on Nifty as crude oil prices remain near highs of 2014. Fortis Healthcare gains for the 6th day running after Malaysia-based IHH Healthcare is said to have put in a counter bid for the company, bidding higher than what's being offered by Manipal Health, and that's a Bloomberg exclusive. Retail prices are expected to edge lower with the Bloomberg survey pegging in at 4.1% in the month of March.
Well, those are essentially the top headlines at this hour. Thanks for tuning in. My name is Neeraj, and the market's looking a lot better than what they were at the start of the trading day. Courtesy, I believe, what's happening to the IT index. The fact that the Nifty bank is in the green is helping, but I think the surge that we've seen in the last 1.5 hours has to be in part courtesy the IT index. That's one space that is doing very well. Before we get to the heat map, need to pull up what's happening to the mid cap and the small cap indices as well. Nifty IT 3.5% higher, as I said. That's the clutch of the market, stocks that are doing well, and we aren't seeing that same cheer spread onto the broader end of the spectrum. But as I said, I mean, the 0.5% move, when you have a TCS, Infosys, HCL Tech, and some of the others moving up 3.5%, 4.5%, you would have that surge coming up in the index for sure. That the fact that the private banks are not underperforming also helps. Bring up the heat map. And fair bit of traction. I mean, the top corner is dominated by what's happening to tech. So HCL Tech, TCS, Infosys, Tech Mahindra, all them are doing well. Aside of that, private banks not doing badly. ICICI and Axis, both of them trading with 1% kind of a gain. And the losers, the OMCs, the losses are a lot lesser than what they were at the start of the trading day. A lot of damage already done. You would probably presume that's why this is happening. But you don't see the OMCs within the top 4 losers. It's got some pharma presence here, but BP, HP, IRC, the losses have narrowed compared to what they were at the start of the trading year. 3% was the order of losses at the start. Now less than 1.5% apiece for each of those 3. What else? The broader end of the spectrum. Well, let's pull up 2 or 3 names. I thought the consumer names today were doing reasonably okay. And aside of that, we've had some gains that have come in to stocks like Dish TV, and we'll talk about that in detail. Nalco continues to rise and shine, and Future Consumer, after 6 brokerages having targets minimum 75 rupees, it's finally come back to 60 odd rupees. Let's see if there is more in store for Future Consumer in the session today. There are obviously, with the gainers come the losers as well. Wakrangi continues to grind lower. Adani Power, which is starting to find favor with the trading community, some buy calls that come in, but no such luck. The stock continues to move down. GMR Infra too, down about 3.5% in trade. So a clutch of names losing out, but largely the day belongs to the large cap IT space, and to an extent we're not seeing too much damage to the banks, which is actually a good sign. But Navneet, what about the liquid universe?
Well, Neeraj, as you said, today's rally has been propelled by the IT stocks, and then in the last 15 to 20 minutes, we've seen some additional buying coming into the system. I think the positive takeaways, we were looking at some bit of resistance for both Nifty as well as Bank Nifty around its 50-day moving average, and as we speak, both these benchmark indices are now trading above their 50-day moving average. In fact, Nifty's 50 DMA was somewhere about 10,425, so it's significantly now trading above that. Let's just pull up the Nifty futures and see if there is any sort of build-up that has been seen. Yesterday, the open interest was up nearly 5%. In today's session, we've seen open interest surging almost 6%. But let me highlight one point. The premium on both Nifty, Bank Nifty futures has been coming off, which is not a very positive sign. Pull up Bank Nifty futures, where in fact the futures have been trading at a discount, which is widened now. That's about 18%, 12% higher in terms of open interest addition for the Bank Nifty futures. If you look at the options data, some positive cues, because there is aggressive put writing actually, which is coming for the 10,400 strike. We mentioned in the morning, now the fight is around the 10,400 mark between the bulls and the bears. And clearly, if you look at the 10,400 put today, 15 lakh shares have been added. Even the 10,300 put strike has seen aggressive writing, and there has been intraday unwinding on the 10,400 call strike, which is telling you probably traders in the morning who would have written this strike, they've already covered their position. Let me take you through a couple of stock futures which are active, and I have to mention IT stocks here. TCS, a heavyweight on Nifty itself. If you look at the volumes today on the cash side, they're 40 to 45% higher than yesterday what you saw on National Stock Exchange. So it's going up on high volumes, which is once again a positive sign. Do watch out for the delivery data. Looks like cash-based buying, because the futures have not seen, actually there also the OI has just gone up in the last 1 hour, 15% higher, but the futures do trade at a discount of 3 rupees. The other one is Dish TV. This is the counter we're going to discuss in more details, but just giving the futures an options trend here. 5% higher. It's been going up in the last it's gone up for 5 out of the last 6 trading sessions. It's crossed the 200-day moving average, so it's broken out of that consolidation phase. The volumes on the cash side have been higher, and let's just pull up the futures. It's one of the top gainers on the F&O side, but not much of build-up seen in terms of OI addition, only about 6.5% higher. Remember, today the news came that the promoters have made an open offer to buy almost 26% stake in the company. And Neeraj, this has just come in after the merger with Videocon went through last month, after waiting for almost 1 year.
Yeah, interesting. And as Navneet said, we'll talk about this in detail as well a bit later on in the show. For now, though, let's get in a fundamental voice on the show. Rahul Arora, CEO of Institutional Equities Business at Nirmal Bank, joins us right now on the show. Rahul, good having you. Thanks so much for joining in. Clutch of things, really. I mean, we can discuss OMCs and the fabulous call that you guys put out almost a year ago. We'll talk about that too. We want to talk about IT as well. But can't not start with what's arguably the top of the mind in terms of news flow, and that's what's happening to private banks. Well, two particular private banks in particular, but generally at the cusp of the earnings season. What's the house view there, and what do you believe about the corporate-facing banks? What should an average investor do? What are your thoughts?
So, thanks for having me, Neeraj.
Pleasure having you.
The tilt at our broking house has been towards retail-oriented private sector banks for some time now. Even though we have buy recommendations on Axis and ICICI Bank, we haven't been pushing them as aggressively. And this has nothing to do with this news flow. We've always maintained that the pain that the corporate private sector banks will have to see will be far more exaggerated than what was being reported. And that was reflected in the provisioning increase that we were seeing. Yes Bank, IndusInd Bank, HDFC Bank, Federal Bank. I think if you're looking at retail-oriented private sector names, these would be the 4 banks that I would look to park my money in. I think some amount of shift already over the last few months has happened here, and there has been a steady move up in these stocks. I don't think the earnings expectations have gone up as much as analysts have stretched the target multiples, to be very honest. But given the fact that financials are almost 35-37%, as an institutional investor, you have to be at least 1 time benchmark to that. So you've got to justify the increase in prices. But I think the other interesting play could be beyond the corporate sector private banks and beyond the retail-oriented banks as well. So we actually have a positive tilt to a lot of mid-cap sector banks like City Union Bank, maybe an RBL, a DCB. Housing finance names like a PNB Housing Finance, something like an Ujjivan. So I think there's enough and more in the BFSI space to play. Gold finance, I mean, you know, they had a very, very poor run between FY12 and 16 when gold was in a bear run. They had just started to recover when demonetization hit. So there's not been a very sustained 2-3 year period of re-rating for gold finance companies. So you could look at Muthoot or Manappuram. So I think beyond just Axis and ICICI, which I think will have their own issues to deal with time time to come, especially since we know at least Axis has their new their old CEO till the end of the year. So you don't know how the results will pan out. But I think even if you leave those two aside, there's plenty to play in the BFSI space or even the housing finance space.
And in light of all of that, Rahul, what have you been telling, or what has been your house call on how aggressively should, not some of your large investors, which I'm sure make the decision on their own any which ways, but a lot of your mid-sized clients who are looking for some analysis, some ground analysis of what the indices could do over the course of the next 3 to 6 odd months?
So I think, Neeraj, I look at things in a slightly more conventional way, and I look at the bond yield very closely because that's what I was taught in college, that you inverse the 10-year bond yield and you get an indicative market multiple. So you're at about 7.5. If you inverse that, you get about 13.5. But markets never trade at fair value. So if you're going into FY 19-20 expecting a 15-20% kind of growth, then the market multiple should be somewhere around 15-16 times. I think the recent fall that we saw, to a very brief fall on the Nifty to 4 digits, so it held on to about 10,000. I possibly think that's the floor for the year. Conversely, I think the high that we have made is probably the high for the year, 11,200. So I think you're going to see a very range-bound market for the better part of this year.
Okay.
It may not throw up as many money-making ideas as last year, but don't expect a tearaway rally would be the way we're approaching it. Okay,
before we squeeze in the next question, I mean, just some flashes on the screen. The oil minister, and I think he's giving out his view that the government has not given any direction to OMCs to absorb the price hike. Now remember, this is in line with what the OMCs were telling us yesterday, that one, that no direction had come in. Two, they did not believe that the government would change the stance which they have so emphatically laid out over the last 1.5 years of deregulation, wherein they would ask OMCs to come in and absorb any kind of hikes in crude prices. As a result of that, these stocks are just coming off the lows of the day. We were just talking about it, how they started off Navneet almost 3% lower, currently about to break even into the green. In fact, the IOC, the stock of IOC.
Despite of the clarification coming in from IOC, BPCL yesterday, we didn't see any recovery coming in. But today, since the oil minister have come out and said they've not given any sort of direction to these companies to absorb any sort of price hike, and hence that recovery is seen for the entire pack, BPCL, HPCL, as well as IOC. Well, moving away from the OMC pack, let's talk to Rahul about the IT pack, which is in focus. We'll be getting Infosys numbers tomorrow. IT pack as a whole on YTD basis, we all know that it's been outperforming. Some bit of buying has come back because it was a laggard alongside pharma space in 2017. I was reading a couple of reports, and this is just 2 weeks back or 3 weeks back, where a lot of these US-based hedge funds, they've started buying Indian IT stocks via the ADR route, which is showing some bit of confidence that growth in US could also be coming back, and hence the rally that we've seen for the Indian IT stocks.
I think, Navneet, what you have to keep in mind when you're analyzing IT stocks is the underlying strength of the US economy. I don't think people, I don't think that point is appreciated well enough, that in the implied guidance or projections, people are actually taking an implied call on the US GDP growth. And we should remember that this expansionary phase in the United States, which started in 2009, has been the second longest since World War II. So at some point in time, there's a lot of talk about the inverted yield curve in the US. The growth will slow down. It's looking all right now.
Right.
Our head of research, Girish Pai, has had a negative view for almost 3 years, and it was a very good call at the time. But I think a lot of the movement that you have seen, and it goes back to the point Neeraj was making a little earlier, has been this issue of NPAs on banks. And I think the fact that people were so underweight on IT, that you needed an alternative large cap sector to park money in, and because you had the cushion of buybacks and IT stocks, you saw some amount of portfolio allocation shifting towards IT, and particularly mid-cap IT names, which have seen...
You're suggesting there's no fundamental reason
I don't think so. In fact, if anything, if I recall our quarterly projections correctly, I think Girish's view is that Infosys may actually negatively surprise the street on guidance tomorrow. Okay. So he's actually not expecting double-digit growth in IT to come back for a very long time. And in the most optimistic case, I think his view is on TCS and HCL Tech, where he's talking about 8-9%. But in Infosys, he's somewhere between 5-7%. And a lot of this has to do with the TCVs that these companies have announced. And Infosys' TCV actually hasn't been as great as it was in the legacy years. In fact, if anything, from a return ratios perspective, there has been a massive erosion in shareholder value. I mean, Infosys used to be a 65-70% return on invested capital company. It's a 35-40% ROIC company today. So something structurally has changed. See, the broad macros on why people are negative hold, digitization, AI, I don't want to get into that. But I think the big delta that people play, that they trade, not invest in IT for, is the rupee. And while our own economist is expecting the rupee to depreciate, it's probably not the reason I would advise people to come in and buy unless you have a special situations fund. And that's something a lot of retail investors won't have. So I think it's at best a trade for about 10-15%. But your specific question on Infosys, I think our view is it'll probably disappoint in terms of guidance tomorrow. And it's best to probably have a neutral stance, not an overweight stance on the sector.
That's across the space for mid-cap IT as well?
Mid-cap IT, I think our downsides on names like Persistent and Mindtree are in excess of 20%.
From the current levels.
From the current levels, yeah.
Interesting. I want to actually go back to that point, Rahul. Oil Minister, the flashes that came in. What's the view on OMCs? Yes, you guys were amongst the first ones to call that you shouldn't, relative to the market, go out and park yourself in OMCs. Now that there has been a price correction, even if there has not been a substantial price correction, there has certainly been a time correction as well. The oil minister clarifying that there is no interference, and this is the second time in the last 3 months that the government has come out and said that, you know, market may think what they want to think, but we are not going to interfere, which is, to my mind, a big relief. What's the stance now?
So, Neeraj, in fact, not this news flow over the last couple of days notwithstanding, we were anyway in process of reviewing our call, because there is no point being married to a call if things have, you know, moved in the direction you want them to move in. So there has been, I mean, at the time when we initiated this report in May of 2017, one of the biggest theses that institutional investors used to give us is that at least it's a dividend yield play. You know, you have 2.5 to 4% dividend yield on HPBP IOC. Depending on how the price moved, it could move up or down. And at that time, if there was any uncertainty on the market, the valuations were also fairly cheap. None of these stocks were coming to you more than 10-12 times 1 year forward. But our call at the time, Neeraj, was that a lot of the balance sheet repair that had happened in the 2.5 years preceding our report was because there was virtually no capex announced by HPBP IOC. So interest costs had come down and there was a very large repairing of the balance sheet that had happened. Now, if you see between here and FY21, the kind of expansion that HPBP IOC are talking about, the interest costs are going to go up quite substantially. So that was one very big call that we had, is that the rate of growth of EPS that the market was expecting was not going to happen. And this was in effect going to be return ratio dilutive. That call having played out to a large extent, obviously we had a view on GRMs and marketing margins where we were also anti-consensus. I think it's best to keep a neutral stance right now. I don't think it's worth going underweight on this sector now, because there's been a 25-30% underperformance over the last 1 year. Now to come in and give a fresh underweight call may not be the right way to do it, is my sense. We may upgrade it to a neutral. I don't want to comment specifically on what we will do because of SEBI regulations, but through our informal discussions that I've had with my analysts, I don't think there's a case to be underweight on this sector anymore, even on the reasons that I have mentioned.
But that overhang of higher crude oil prices would always remain for them.
It depends, Navneet. I mean, there is no empirical evidence to suggest. I mean, the biggest bull market in crude actually coincided with the biggest bull market in Indian equities, which was 2003 to 8. So I don't think there is an established correlation with how these things work.
Okay. Let's talk about the space where stocks have been trading around their all-time high. I'm looking at a couple of the tire stocks. Apollo Tyres, you've got MRF, Bala, all of them have been going up. And I guess there are multiple factors. The rubber prices globally, which is a raw material for them, has been coming off. And I think the budget, they announced that the custom duty was increased to about 15%. And all of this has been working really well for them. What's the call here? Considering the stocks are at all-time high, do you see more value? So
Bala Industries has been our top pick in the tire sector. It's done really well because after the last quarter's numbers, the management upped the guidance by about 15%. And the stock, I remember that week, virtually went up by 20-25%. And the interesting part, I think, which is not entirely appreciated by the street just yet, not because the valuations are probably half of what the OEMs are, but the force with which the replacement cycle can come through, especially in the tires, I don't think is fully appreciated by the street. I mean, I can give you a classical example of an OEM, and a lot of people believe that the Royal Enfield story is over, and you know the waiting periods are coming down and the market is saturated. But I keep going back to the point that for people who are driving a Splendor or a Passion, to graduate to even the lowest price car of a Maruti is on an on-road cost in Bombay would be about 3.5 lakhs. So it may not be the straight jump that they would take. So, I mean, you know, the Royal Enfield story, for example, started at the turn of this decade, around 2011-12. And if you assume a 6, 7, 8 year replacement cycle, there's an entire replacement cycle that's going to come through. So anyone that supplies to these guys is obviously going to be a beneficiary. Now, Balkrishna, for example, is very big on the off-roads, heavy heavy vehicles. And just look at what's happened to the CV cycle and the MHCV cycle globally. I mean, Caterpillar globally has raised its guidance after the last quarter's numbers, and that should be an indication of what's happening on the off-road and the heavy vehicle segment. So I think it's if you're already holding these stocks, there's no point selling them right now.
Okay.
A fresh investment, because these stocks have seen such a sharp run, it's a toss of the coin. But if you're looking at it from a valuation standpoint, I still think that there could be one more round of a PE multiple expansion that you might see after the fourth quarter. So you might want to hold on. If you're having a slightly sort of a 6-month view, I would still say that these stocks are not a bad entry point, but I don't know if they'll continue to expand their multiples 6-9 months on. So it's probably more a short-term investment rather than a longer-term investment, I would think.
Okay. I just want to mark, IOC, HPCL once again, maybe not as much BPCL, but IOC and HP are now trading about 1% in the green, and that's a sharp pullback from the lower levels. So keep on watching out for these names. Chennai Petro, which was trading deep in the red yesterday too, has moved in marginally in the green. So good moves for some of these stocks in the last 15-20 minutes of trade. Okay, Rahul, a couple of thoughts. I think two names on which you guys, I think, had conviction and had given calls earlier. Correct me if I'm wrong, but Jubilant FoodWorks and the management changed there. Now it's just skyrocketing. What happens here? Two, something which is not discussed too often, but I remember you sending me a note of that stock when it was maybe 600, 650. Shelley Engineering Plastics. I don't know if you guys still have the coverage on it or no, but it's at about 1350, 1400. Both classic consumption names in a manner of speaking, institutional versus retail, so that's a bit of a difference there. But what are your views here?
So on Jubilant FoodWorks, Neeraj, I think it has caught the street by surprise with the ferocity of the move.
Would you attribute it to that change of management?
I think there are a few things that have happened here, Neeraj. I think a lot has to do with the change in management, but there are so many factors, and I'm not sure we have the time to discuss them all. But I think you know, it had reached a stage where the global CEO of Domino's said that their product was a bad product. And he said that at their AGM. So I think if you look at what Domino's has done with its product, they've introduced thin crust, whole wheat, multigrain, low-fat milk. There has been a definite shift mentally towards health. They have increased the size of the toppings, both veg and non-veg, by about 10% compared to what they earlier were. They've done away with buy one, get one free, which was a deferred purchase to an everyday value, which has actually resulted in a huge spurt in volumes. And the most important thing I think is they've done is rationalize store expansion. So under the previous regime, they were opening 100, 150 stores every year. I don't even think they've opened 30 this year.
In fact, they've been shutting down loss-making
absolutely
stores. And
I think that's you know, so when you're it's a numerator on denominator. So when if you're taking the denominator as stores, the fact that you're not opening the stores if your top line is growing, your SSG, your same store sales growth automatically is going to go up. So our own call is that this quarter, I think they should be doing a 16-18% kind of same store growth. The point here, Neeraj, is I was looking at the numbers, and in an absolute blue sky scenario, they'll probably land up doing 60 rupees EPS in FY20. It could potentially come in 21. I'm saying 20 in a blue sky case. It should come through by 21. Now the question is, what multiple do you want to ascribe to the stock? So even if you want to ascribe it a lever type of target multiple, which we have given at 50 times, at an absolute blue sky scenario, I get 3,000 on the stock. So it's already at 2,500 plus. So my sense is it's probably in the last 3, 4, 500 rupee point of its move. Remember, the rally on the stock started from about 800
But you're talking
bucks.
about 3,000 FY20.
I don't think the stock will wait that long, Neeraj. I think if a 16-18% same story. See, one criticism I have about my industry is we're always reactive, not proactive, and this holds through from the largest brokering house in the country to me. So when if that number actually comes comes through, I see one more round of upward revision. Analyst P's will become absurd. And the one very important factor which I highlight in Jubilant, it's a 47-48% FII owned stock. So you have to keep that in mind when you enter a name like a Westlife or a Jubilant Foodworks. These are predominantly FII owned stocks.
But is it an industry trend? We've seen same-store sales growth improving across the rest.
Absolutely, absolutely. But I think the fact that you know, the point here is the same-store sales growth saturating for these guys? And it may interest you to know that in a market like the United States, for the last 20 quarters running, Domino's has not reported a negative SSG. That's a fairly saturated market. So I think obviously these double-digit SSGs will not sustain. The base effect will come in and they'll probably go back to single-digit. But I'm not too fussed about that, because when this was a 60-65% return on capital employed, return on equity company, and 19% margins, it dropped down to single digits. So I'm saying even if it goes back to half of where it was, inflation is at 4.5%, 5%. If he's able to consistently do between 7 and 9% same-store sales growth, we're home. You probably get 3,000. It's a liquid enough name. People could still buy it playing for a target of 3,000. But my sense is if that 3,000 is to come, it will come through in this current calendar year. It will not drag on to next year, and it will probably happen sooner than we expected. But to expect a multiple re-rating from here, I think that's by and large played itself out. It's been more than a 3 bagger.
You're expecting EPS of 20 in FY20?
No, I was saying if it does 60 in FY20, it'll probably do 30 plus this year.
Yeah.
So I was saying in a blue sky scenario, if they do 60 in 20, or maybe even 60 in 21, even if I'm discounting 2-3 years out, I'm not getting more than a 3,000 upside. So I don't know if it's as vociferous a buy for me today as it was in the past. On your question on Shelly, I can comment a couple of lines, because currently the analyst actually left us, but so we don't have the stock officially under coverage, but I think it's a brilliant proxy on IKEA. Very strong return ratios. The problem, Neeraj, with Shelly is liquidity. DSP BlackRock in their small cap fund holds about 8-9%. If I'm not mistaken, I think Ashish Kacholia holds about 8-9%. And there are 1 or 2 other institutional investors. So I think between 4 people, there's about 32% of the float gone there. So even if someone believes in the story, and till we covered it, it was a 20% compounder for us. Sure. So the float in the market is so less, I don't know if people will be able to buy. It's re-rated. It's done fantastically well. There are a lot of savvy investors in it. But I think it's a brilliant proxy. IKEA is opening up about 8 stores in India, and globally IKEA has actually cut down its vendors from 2,200 to 800, and Shelly has stayed with them. So I think the rate of growth will be proportional to what IKEA is. Officially, I don't have a price target yet, but the stock's done so well. Sure. If your investors are able to find float in the market, maybe, but it's a bit of a tricky call to give the way the stock has re-rated. It's a small cap name at the end of the day, despite the run it's seen.
Great. Rahul, so good having you. Thanks much for taking the time out and speaking to us.
Thank you so much.
Yeah, pleasure having you. Okay, earlier in the day, a host of experts spoke to Bloomberg Television and shared their views on the higher oil prices and the impact on the Indian markets as well, and the emerging markets at large. Hear out some of those views.
I can tell you very frankly here. Very high oil prices are not in the interests of the oil importing countries, especially this country like India where we are now, ranging from the economic growth to trade balance. But also, perhaps as important as that, high oil prices, very high oil prices for a long time is not in the benefit, in the interest of the oil exporting countries as well. So one should be very careful what one is wishing for. Very long time, very long prices is not in the interest of the oil exporting countries and oil importing countries, and as such for the global economy.
Well, if you look at Asia generally, and certainly India, but also markets, say, like Korea or Taiwan, and indeed Japan, they're very large oil import bills relative to GDP. So it acts as a drag on growth and potentially even on the currency in the case of India. And that's not good. It's a reason to be incrementally more cautious on those markets. Whereas if you say, look at a market like Brazil in particular, that's one of our key overweights, it's very divergently impacted. So, at the margin, what this suggests, the oil factor is more ASEAN exposure, which we touched on in the earlier segment, and more exposure to Brazil, and somewhat less in Asia, particularly in Korea and in India. In both of those markets, we've been reducing our weightings in recent months.
Well, I think oil prices are a big problem for India, and they always have been. But if you look at the current situation, so it's not just about inflation. I think obviously inflation would respond to it. And the second thing is that India's current account deficit. So we've seen that the current account deficit has widened in the last quarter of the year of 2017. And just a crude arithmetic would tell you that every $10 increase per barrel is going to give you a wider current account by 0.5% of GDP. So it is a problem. Now, one thing though I got to say, which is different from 2014, is that India's balance of payments as such is in a much better shape. And if you look at FX reserves, the stability of the currency, so there are mitigating factors at this point in time. But yes, if we move towards 100 or something, then the defenses start to crumble.
Okay, that's some global view coming in on the commodity space. But moving on, March seems to have been an aberration for the cement companies, with prices recovering in the month of April, but not all regions have seen a price hike. What's also worrying is the fact that the quantum of the hike has been limited this time around, despite April being, in the middle of a busy construction season. We've not seen that sort of hike. And Nikki Mirchandani is here to take us through the key highlights of the report put out by Kotak Institutional Security and her conversation with some cement dealers. Nikki, over to you.
To this one. Well, there has been a recovery that we've seen in cement prices for the month of April. If you look at the all India cement pricing trend, you would see that the prices have actually increased by as much as ₹5 per bag. This compares to a sharp cut that we've seen to the tune of ₹9 per bag in the previous month. Recovery, however, is not in line with expectation, given that, as Navneet pointed out, we are in the middle of the busy construction season, and also the prices levels are now compared to the levels that we've seen a year ago. Also, if you see, the recovery is mainly coming on the back of the pricing demand scenario, the pricing trend that we've seen in western, southern and central region. To begin with, the first region that we're looking at is the western region, where the hike has been the sharpest that we've seen in nearly 11 months, where these players in the region have hiked the prices by as much as ₹8 per bag, after seeing a cut of ₹5 per bag in the previous month. Also, if you look at the trend that has been played out in the region, Maharashtra has seen a good sharp hike, and the sharp hike has declined. Prices have actually declined in Gujarat. We had Bina Engineering, the whole-time director of Sanghi Industry, who confirmed this to us. She, however, says that she sees a better trend going forward in terms of price hike for the region. Next in the list, we have South India, where the price hike is at least the sharpest that we've seen in 3 months. Now, the players in the region have taken a hike of a good ₹9 per bag, as compared to ₹17 cut that we've seen in the previous month. Also, we've seen some respite coming in the prices of central India, where the prices have actually gone ahead and the players have taken a good hike. However, the trend somehow is a bit different, both in your eastern India as well as in northern India. If you look at the eastern India, the prices are pretty much stable there. They've not been cut, not been hiked. However, it's a little bit different that we've seen in northern India, where the players have actually gone ahead and taken a cut further in the month of April as compared to that of March. Also, I spoke to one of the dealers there, and they said that after the 2 cuts that we've seen in the 2 months, now prices could actually increase to the tune of ₹10 or ₹15 per bag. Back to you guys.
Thanks a lot for that, Nikki. So that's the view on cement pricing trends. I tell you though, a pocket of strength for the markets has been autos and auto components. And within, auto components, I'm usually using that term. I think tire companies have been on a really strong bull run. The question, the next guest is a very special guest, the management of Apollo Tyres, joining us on the show to talk about the growth prospects for the space, for the company, and what is it that Neeraj Kanwar is seeing across the globe in this pocket as well. Good having you, Mr. Kanwar. Thanks so much for taking the time out. And thanks for speaking to us at Bloomberg Quint. I don't think tire companies could have hoped for a better last 12 months in terms of all things falling into place. The demand, or rather the duty on Chinese tires, the recovery in the CV space, passenger vehicles doing very well too. It's been a great last 12 months. Do you expect that momentum to continue?
Well, firstly, I don't think it's been one of the greatest years last year, given that the raw material prices are still high. It's been a challenging year as far as margins are concerned. But yes, on the overall revenue side, it has been very positive, especially when we look at various aspects and reforms that the government has taken in terms of demonetization, GST, really impacted the Chinese imports into India. At one point, they were nearly 30% of the truck radial market. Today, they are down to nearly 1/3 of that. So it's really helped the Indian tire industry's growth within India. Also, the anti-dumping duty came into effect in the later part of the year. So Chinese tires have come down. It's helped the revenue stream for the Indian tire industry. But still, it continues to remain a challenge on the margins. Raw materials are still challenging across the border, may it be natural rubber prices, oil prices, carbon black availability. These are all causing challenges to the bottom line. But as far as going forward is concerned, I'm very bullish. I see the momentum still up, very positive, both on the CV side and on the passenger vehicle side. And I see Q1 and Q2, at least the first half of the new fiscal year, I see double-digit growths coming in as far as Apollo is concerned.
Mr. Kanwar, so yeah, actually I was trying to talk about the demand and you know, really just India demand. We'll talk about the global scenario and the raw materials as well, but purely the demand, the fact that there is this anti-dumping duty plus the resurgence of the auto demand and GST as well, I would presume that would have played a small part, and wanted your opinion on how big a part could that play in drawing the demand from the unorganized to the organized space. Do you see that being a telling contributor when you're talking about this double-digit demand in the first couple of quarters?
Well, like I said, you know, all these factors are playing a positive sign to the economy, especially to the tire industry. GST in the long run, yes, it is going to help the supply chain. Already we are seeing signs of it. It's also helped us of the cheap imports that were coming in from China, so that's also helped us a lot. And I see that the momentum, given the infrastructure that's going on in the country, given the government is investing a lot in infrastructure, this is going to give another growth to the CV industry, which is again going to help us on the revenue side. In fact, today I see that the demand is in excess of what we can really supply to both the CV industry and to the passenger vehicle side industry. So times on the revenue side are good.
Mr. Kanwar, good afternoon. We've seen good monthly sales number also being reported by a lot of these automakers, and especially the CV side, as you've already highlighted, is doing quite good. You derive almost 40 to 45% of your revenues from the truck tire space. Could you tell us how is the demand shaping up there? Because this is one segment in the last 3 years has not seen much of growth.
Well, you know, in the beginning of the year, we started, I would say it was a flat growth rate. As we went along, after demonetization, after GST coming in, we've seen uprise, a growth coming in, specifically for Apollo, because Apollo plays, as you mentioned, Apollo plays a major factor in the CV segment. 60 to 65% of our sales is in this segment. We are the leaders in this segment. In truck bus radial, we are upwards of 28-29%, and so are we in the buyer segment. So I think when I see the CV segment that's gone by in Q4, we've seen a very good positive trend as far as growth is concerned. I would say in the high teens is where I would put a number to. We still have to come out with the results, but as far as volume is concerned, I'm looking at a high teens volume growth in the CV segment for Apollo. Given that we had already envisaged this upsurge coming, and we had taken on a capex improvement program in Chennai, a growth capex in Chennai of taking our current capacity and doubling it up from 6,000 to 12,000, and that's going as per timelines. We would be touching close to 9,500 tires per day today, and we are reaching our 12,000 in another month. So that should really give us another boost to our top line growth once that peak capacity has been met in Chennai, and that will obviously reflect in revenues.
Since you spoke about your capex plan, could you talk to us more about the new plant in Hungary? How are the operations shaping up there? And I guess you were also investing in Andhra Pradesh.
Yeah, sure. So, as you know, in Hungary we've invested close to 500 million euros. I think the plan is going as per what was outlined. We are currently at around 8,000 tires in the passenger car segment per day. We are ramping it up very fast. We're supposed to reach by September 16,000 car capacity per day. So we are, as per timelines, we are moving ahead. Truck bus radial tires are expected to launch in the month of May, June of this year in Europe through the Hungarian plant. So no complaints that our Hungarian capacity is going as per what we have outlined. We are very happy with Hungary. We are very happy with the work culture there, and we are seeing the production numbers and the quality numbers coming out in the right manner. Secondly, Andhra is what you just mentioned. We did take over the land last year. We did sign with the Andhra Pradesh government. Currently, I'm not in a state to tell you where, the amount of quantum that is going to go into Andhra, because we're still at a project stage. But what we are looking at is building a capacity of nearly 16,000 passenger car tires per day, plus continue to grow our truck story as the CV segment in India is growing, and that we are looking at making a capacity of close to 3,000 tires, truck radials per day. So that will again give us a boost in the next 18 to 24 months when that capacity comes online.
The assumption, Neeraj, is that for you as a company, the capex intensity will ease off post FY19 and your free cash flows will improve dramatically post that. Are these reasonable assumptions, or do you believe the timelines could extend a bit?
No, I think this is a realistic assumption, because all the capacities are going to peak in this year. So FY19, FY20, you will see capacity enhancement increases happening and free cash flows will come in. The investments that I'm talking about in Andhra are only going to start in the later part of FY20. So free cash flows should come in, and the revenue growth that you will see is going to come in because we will be reaching terminal capacities by the end of this fiscal year.
And I would reckon that Europe would start contributing in a meaningful way as well, because unless I'm wrong, after the first week, 9 months, you had already started seeing some improvement in the European region.
Yes, so you will see that in Q4, that the year that has just gone by. I think we've done very well in Europe. Even though the economy has been maybe 1 to 1.5% growth, but I think we have surpassed that, and we have gained on market share in Europe. Our volumes have done good for us. So we are slowly inching up, and Europe is coming back into action for us, given also that Hungary is coming online, and we are getting good cost of manufacturing coming out of Hungary, good products. So overall, I'm pretty bullish about Europe and the way I see Europe going forward.
Mr. Kanwar, just before we let you go, the outlook on rubber prices, because that's been the reason why most of the tire stocks have been trading around their 52-week high mark. And I also wanted to know, the December quarter margin saw a bit of blip, so can the fourth quarter numbers be better considering the rubber prices have been coming off?
So rubber prices have really not been coming off. I would say they've been at a similar rate as before. So margins would be under pressure. I would not like to project anything for Q4 as yet. But as I mentioned already, on the whole, raw material basket still remains a challenge for us going forward. and that's really going to be a big challenge for the industry. While the revenues are going to be growing because of the growth coming in the Indian industry, the challenge still remains the cost push that one is having and the effect that's having on the balance sheet.
Okay, Mr. Kanwar, we'll let you go on that note. Appreciate you joining us today and taking us through what's happening with the tire space and also with Apollo Tyres. All right, that was the management of Apollo Tyres, who did highlight that the margins could once again be under pressure in the fourth quarter. Remember, in the third quarter, they were under pressure. And in fact, he's also reiterated the fact that the street has been talking about that the rubber prices globally, which have been coming off, according to him, they've been at the same level. All right, talking about the markets, Nifty is at 10,446 as we speak, 29 points high. So it's come off a bit. From the high levels of the day. Bank Nifty weekly options expiry day expects some bit of volatility to come by today. So that's also about just above the mark of 50-day moving average. Quickly, let's get in our technical experts. Bala, Chief Market Technician at Cash Techniques, is joining us. And also we've got Rahul, Randeria, Technical Analyst at IFCI Financial Services, right here in the studio. Jay, good afternoon. If I could come to you first, what's the view here? We've rebounded almost 400 to 450 points from the fall that we've seen from current levels. Do you see more of consolidation?
I think there's likely to be a short-term pullback. The important resistance for the market is at about 10,475 and 10,625. But my sense is that this market has got a lot more legs, and any pullback is likely to be very shallow, and that must be utilized for being long in the market. Several weeks ago, I had mentioned that the market has a possibility of going down to about 9,800. Placed about 25% probability of market doing that, but I think that's dissipated a lot. There's a good chance that the market has already placed an important low at 9,951, and it's, like I said, it's the medium-term price objective is about 11,400 to 11,500. I think the markets are heading towards that. We've been bullish on Brent, and Brent has broken out beyond 71. So you'll see all these things playing out, and IT is doing pretty well. For every week between February and March, we had at least one bullish IT stock which we had picked up and identified and said IT index is going beyond the January highs. So the message from the CNX IT index is that tomorrow it's likely to start off with a very good result season for the IT stocks, and within the frontline names, TCS is likely to do better than Infosys.
Okay, let's also before we get to Devang, Mehta, Rahul Randeria with us, and let's talk about him with the charts as well. Rahul, how are you approaching trade this afternoon? One on the key indices, and what about the specific stocks that you're recommending today?
Yeah, good afternoon, Neeraj. If you look at last 2 days of Nifty daily charts, it has been taking some pause around its 38% retracement of that particular fall from the levels of 11,171 to 9,951. Now today, again, it has taken an attempt to breach those levels. It just made around today's high around 10,465, 467, and we had a target of 10,478 on the Nifty spot levels. It has almost been done, but slowly and gradually some sort of exhaustion is seen, just because of we have seen that apart from technicals, we have seen rupee getting weaker, crude shooting up, and some sort of bond yield getting on the higher side. So definitely some sort of exhaustion is seen, but looking at the charts, until unless there is no weak pattern being developed on the daily charts, one should be long on Nifty. On the upside, as we said, that 10,478 would be the immediate target, and if it sustains about that, then that could be the next target would be around 10,560, which is the gap area, and it is an island reversal gap which was formed just a couple of months back. So definitely one should trail the stop loss to 10,300 and buy on dips around any dips maybe 0.5% in correction in the Nifty. In Bank Nifty also there has been a gap of 25,400 on the upside on the Bank Nifty spot level. So definitely that is the positional target. But on the downside, one should play with a strict stop loss of 24,800 on Bank Nifty spot.
How individual stock ideas?
Yeah, I have two short-term positional call. First is a buy in FSL. After a couple of days of consolidation, stock has given a breakout and it is near its 52-week high. So stock had each back to the levels of 62. Traders can buy, short-term traders can buy at current levels and on corrections with a stop loss of 55. Target would be 62. The second buy call is in Havels. Again, after a consolidation, stock is slowly and gradually inching back, and stock has potential to test the gap area of 555 in short to medium term. So traders can buy at current levels with a stop loss of 535 for a target of 555 in Havels.
Jai Bala, I think you spoke about what Infosys versus TCS, etc. could do, but if I can urge you to give me your stock recommendations for the afternoon first.
Yeah, there are, again, once again, IT is giving tremendous opportunity here. And, I have two from the broader BSE IT index has got many names to pick from. And I like three names out there. One is Ramco Sys, another one is TVS Electronics. But these two have a higher risk because they've already moved from where they were earlier this week. But, the first one I have is Nucleus Software. It's done a very sharp move between August and January, and then pulled back in a in a very important ratio to the recent low of 370. From 372, it has a very two important ratios are coinciding at the low of 390 and to 385. So the markets are this particular stock is bouncing from that level, and it's producing an important price action. And the message from the stock is that it's heading somewhere beyond the January highs, somewhere close to about 700, and it's got very strong upside potential. And the second pick I have is Thermax, and Thermax has once again the message is that the upside that it did a couple of months ago is incomplete, and the recent decline from the recent high is moving down in a harmonic ratio. And we are looking at this stock taking out record highs and go well beyond it, somewhere close to 1700. So these two stocks are representing a low risk entry point at current levels.
Okay, Devang Mehta, Director of Equities at Centrum Wealth Management, joining us on the show as well. Devang, good afternoon. Thanks so much for taking the time out and speaking with us today. Can't help but take our eyes off IT and the kind of moves that we've seen out here. What are you guys, or what have you guys been doing? What have you been advising, buying yourself within the large cap IT space? Because almost everything seems to be working today.
Good afternoon. Thanks, Neeraj, for having me on the show.
Pleasure.
Yes, I think IT, which was a sheer underperformer for the better part of, I can say, if last 2 years, has just started to work well in the last 6-8 months, to be precise. And I think there are multiple tailwinds for the sector, right from the cross-currency movements to also what's happening across in US and Europe. There is surely a bit of recovery which is happening across the global economies, which comes to help the IT sector in India's IT sector, which is of course more export oriented. So in terms of, yes, in terms of stock prices or in terms of stocks or companies, we have generally been overweight on a couple of large caps like the TCS and Infosys of the world. But TCS is more of a dominant, I can say, participant in a lot of portfolios that we carry. And we feel that this quarter numbers would probably be better off than what we have seen in the last 2-3 quarters. And I think from here on there can be a sort of a recovery in terms of the fortunes of IT sector, at least for the next 2 to 3 quarters.
Okay, that's the view coming in on the IT pack, and the markets are just about 10,452 for Nifty, and Bank Nifty is little volatile now. It's just trading with gains of about closer to 70 points. Tata Elxsi is the one among most of the ID stocks have been moving higher in today's session. But besides that, some bit of cool off has definitely been witnessed for the metal space. And let's not forget the Nifty Metals Index was quite active in the last few sessions. Devang, what's the view for the metal counters, and considering the whole news flow around the trade warfare brewing between US as well as China, and we've also seen the aluminum prices inching higher, on back of which stocks like Vedanta, Hindalco and National Aluminium have been doing well. What's the stance in this sector?
So these are classical, if I can say, more of a tactical plays rather than pure fundamental plays. Why I say this is because nowhere in a fundamental scheme of things the stock fit, as there is enough cyclicality among those in terms of not only earnings but in terms of what happens to the global trade, but in terms of the prices shooting out of the roof for aluminium and such allied metals. I think there is a good trade happening there, and there is no reason why people should miss it. So for a period of, I can say, 2-3 months or a quarter or couple of quarters, it would be more of a tactical 10-15% type plays rather than more fundamentally active plays, which generally we avoid in a longer term portfolios. But yes, for medium term investors wanting to make a sort of a quick buck, there is some bit of, I can say, certainty that you can make probably a 10-15% type of a trade here.
Okay, amongst other stocks, I think Dish TV is looking fairly strong today, up about 5%, Navneet.
That's right. It's one of the top F&O gainers we did highlight at the start of the show. And just want to tell, it's up almost a day's high, 6.5% higher for Dish TV. And it's gone up on that news that today promoters, informed the stock exchanges that they've made an offer to buy 26% stake in the company. They're willing to infuse almost 3,700 crore, that is by buying that much stake. The open offer price is at about 74 rupees. And clearly, the stocks moved above that price of 74 rupees. Now, just want to remind our viewers, one of the promoter entities of Dish TV, which is Worldcrest, they bought nearly 5.02% stake in this financial year. Now, according to SEBI rules, if one of the promoter entities, they buy more than 5%, which is called a creeping acquisition, that triggers an open offer. So this news of open offer is actually on back of the creeping acquisition that one of the promoter entities have done. But also there's a lot of news flow, street buzz in the, around the street. If you look at the current shareholding pattern, let's not forget the merger with Videocon just went through last month. It was lingering on for over a year. That took a lot of time for approvals. So the new shareholding pattern is where Dish TV has almost 33% stake, Videocon 23%, and with public almost 44%, which also includes Subhash Chandra's stake of somewhere about 4.5 to 5%. Neeraj, the ongoing issue with ICICI Bank and Videocon is now as an account being referred to NCLT. Street is speculating this move could also mean to provide an exit to Videocon, because now no public shareholder is going to tender their share. It's already gone above that price of 74. It's 78 rupees. And the other point to note here, a promoter infusing as much as 3,700 crores speaks volumes about the move. Okay, that's about Dish TV. By now we know the reason. It's a day's high. Devang, any view here? What have you made of the news that has come by of the open offer?
Not covering the stock, so wouldn't be appropriate to comment on it. No need.
Okay, no problem. But if you look at technically, the stock's also moved above its 200-day moving average. Rahul, correct me if I'm wrong. How is it looking on the charts?
Yeah, if you look at the charts, the stock has been given a breakout of small inverse head and shoulder break pattern on the daily charts. But on the upside, 81 is the area where there is a cluster of resistance zone. So definitely today's spike would take a pause around those levels. So those who have bought at the lower levels, luckily a couple of days back, can try to book profits around 81, 82 in the coming days.
Jay, what about you? Do you track Dish TV? It's now nudging the fresh highs for the day.
Yeah, definitely. The short-term trend has definitely reversed. When the stock went down to 64, it made a spike low. Basically, there was a strong price ejection. When it crossed 71, the stock clocked a higher high and a higher low. And as Navneet has rightly pointed out, it's taking out the 200-day moving average. And with a higher high and a higher low, and above the 200-day moving average, I believe there's further upsides for the stock to come, at least 86 to 90.
By the way, stocks which are trading at new highs include Mastech, which is at 588, Tech Mahindra, which is at about 648, and then Tata Sponge Iron, which has gained about 8% today at 1170. That's packing some serious sponge for itself. Devang, finally, I mean, we've discussed IT and metals as well. Just looking at the list of names which are doing well, includes this entire clutch of retail names. I mean, Future Retail is a case in point, but we've seen Shoppers Stop post their Amazon partnership doing reasonably okay. Trent has been on a roll the last few days, and the less spoken about V-Mart Retail. well, you actually can't speak too less about it. It's a stock that's actually given some very handsome returns to investors over the last few quarters. How are you guys viewing this pocket?
So in fact, if I can count these companies as a consumption type of a basket, or in fact, as you said, a retail / consumption type of themes, we have been very positive on such type of, I can say, companies as well as sectors where we have been seeing that probably post demonetization or post GST, the organized retail has come to the fore, as well as the consumer itself has become a lot aware, and I think the spending and the aspirations of the middle class as well as the upper middle class Indians is it's towards all this I can say consumption products, right from apparels to even wellness products to beauty products. So I think this segment is growing very fast, and I don't see any reason why one should be bearish on this. Of course, valuations would be rich at this point, but they would only get richer as the volume growth, as the margin expansion in this segments start growing up. So I think yes, these are some of the sectors and stocks which probably even in a bad market situation would outperform the overall, I can say, the market gains.
Okay, Devang, before we thank you, you seem to be bullish on insurance as a theme. These aren't cheap stocks. Why do you like them?
So again, clearly here the theme is not only the financialization of assets, of physical assets, which is going to happen, but I think as a nation, there is a clear demarcation now that insurance, which was traditionally only sold in the private sector as a ULIP product or a unit-linked insurance product, is now sold more as a protection product for even younger people and people who are having the business. So not only life insurance, but even general insurance has started to get some traction. The penetration as well as the density of insurance in India is typically very low, but with a lot of such private players which are now emerging as sort of giving competition to the most time the monopolistic player like LIC, I think good days are ahead. And as I said, the awareness is only increasing. Plus, a lot of this company work on a wonderful operating metrics, plus good product mix. Companies like HDFC Life having excellent product mix. I think all this plays towards the financialization wave which is going to happen. Plus, I think yes, valuations, as you rightly said, will be expensive because not many companies are listed. Of course, 3 or 4 private sector companies have got listed, and many are waiting in the wings to get listed. So I think there is a lot more penetration and a lot more market share to gain for such companies. So I think it is a lot prudent to buy something in an insurance space rather than in the plain vanilla NBFC or the bank space.
We'll leave it at that, Devang. Many thanks for joining us today and giving us that perspective. Well, I think something's brewing with Dish out there. It's now up 10.5% Navneet, 81.45, and I think big volumes as well.
Very high volumes, Neeraj. I was just checking, just on National Stock Exchange, about 2.8 crore shares have been traded, as opposed to almost 50 lakh shares which were traded in yesterday's session on NSE. So it's going up on the cash side on very high volumes. We will be watching out at least for the delivery data here. And the news report actually suggests, because the offer price is now 74, it's moved above that. Let's see how the open offer now pans out. But it's time for us to slip into a very quick break here on Countdown. Don't go anywhere. On the other side, we get you the Fab 4 stocks of the day. At 3:15 p.m, we tell you what the dealing rooms are recommending in trade, and we'll also be getting you some closing strategies from our technical experts. Stay tuned.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार, just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
RP Sanjeev Goenka Group, growing legacies.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Backward closing trade, a backward countdown right here on Bloomberg Quint, and 26 minutes left for the closing trade to click in, or rather the trade to close. And we have the IT names doing really well, about 0.5% higher for the Nifty. For the Sensex, the Nifty about 0.38%, and the Nifty Bank to doing reasonably okay for itself. Actually, Jay, if I can ask you, can somebody go out and initiate a long on the Nifty IT index today? There is Infosys tomorrow, and which will probably have a bit of a bearing on what the IT index could do as well. But is it a safe trade?
I wouldn't call it a safe trade, but my medium-term price objective for the CNX IT index is about at least 13,800. But from the looks of it, it's crossed 13,100 rather swiftly. And the way the price action is shaping up, the message is that Infi is going to at least meet the market's expectation and probably see guide slightly on the upside. So that's the way the price action is. I'm reading the price action. So if the markets were to cross 13,500, by some chance, say by Friday or Monday, I think I need to revise my upside targets for the CNX IT index to somewhere close to 14,200 or even 14,800. That's the way the IT index is looking at this point of time. But I always look at markets from a risk perspective, and given that it's at 13,100. I really don't know where to place the stop, and it could be somewhere quite low. But if you are a high risk taker, it's definitely a buy here.
Okay, so it's a buy on Nifty IT, and Neeraj, yesterday one of our FNO experts on the FNO show, Amit of BOB, he had recommended to go long on Nifty IT, so his call definitely seems to be working well. But moving away from the IT pack, there are a whole host of other stocks that are buzzing in today's session. So let's get you the Fab 4 stocks of the day. Yash Upadhyay is here to take us through the same. Hi Yash, good afternoon.
Good afternoon, Navneet. So first up, we have OMDC. This one had been locked in an upper circuit of 20% at one point in the day, but is now sitting at gains of around 10.5% after the company said that it has received 6 iron and manganese ore mines on lease from the government of Odisha. Dish TV is up about 8% after the promoters made an open offer to acquire close to 50 crore shares, or about 26% of the total equity, at a price of about 74 rupees per share, amounting to some 3,700 crore rupees. Capacite Infra received a big order. It's up about 3% after the company said that it has received a repeat construction order from one of its clients, Seaview Developers, worth close to 160 crore rupees. And finally, Hatsun Agro. This one is up for a 4th straight day and is sitting at gains of about 5% after analysts expect the company to have a strong 4th quarter, reporting a mid-double-digit kind of a growth. Back to you.
All right. Thanks a lot, Yash, for bringing those Fab 4 stocks of the day. Let's bring in our next guest in the show. Mayuresh Joshi, fund manager at Angel Broking, is here with us. Hi, Mayuresh. Good afternoon, and thanks a lot for joining us. I'm going to take forward one stock among the Fab 4 stocks that featured in our list, and that's Dish TV. We've already discussed on the show. Just wanted to get a view from you. What have you made of the open offer? Well, it has been triggered because one of the promoter entities, they bought more than 5% stake in the company, but there's a lot of street rumor going around that this could also mean it could provide an exit for Videocon, because no other public shareholder will tender their shares at 74 rupees now.
Afternoon, Navneet. So I think if you work at all the permutation and combinations, and if one really assumes the scenario that you probably put through, I think the spike that you're seeing looks quite logical in that sense. But the second element in terms of the argument, apart from the open offer being triggered, is also the core dynamics that will change once the Videocon deal comes through and the consolidated numbers start getting reported. So the kind of indications that the management has given, 180 crores to be saved in the first year, 530 crores in the second year, almost 720 odd crores in the third year. I think there is a very logical explanation to what they have done. So interest cost rationalization, saving of set-top boxes of almost 110 odd crores. You're also probably looking at the content cost for Dish TV being far lower at this point of time at 32 odd % compared to a Videocon at 35 odd %. And again, what happens with the tariff ruling, I think that's going to be a sweetener for a lot of distributors. So I think synergy benefits, if they start drilling through, and even if one assumes a discount to the synergy benefits that the management is talking about of anywhere between 40-45 odd %, you'll still got substantial cost savings. And again, margins expected to remain at higher levels because of all the deals that can probably come through at lower levels. So a large element in terms of the earnings propensity probably for the merged entity with a subscriber market share in excess of 40-45 odd %, a base of 30 million odd subscribers, I think that should give it the balance sheet advantages as well. So yes, I think it's not done great over the last few quarters and years, but these synergy benefits, if they do play out even at a discount, as I mentioned, there is still some potential upside considering the operation parameters. ARPUs have gone down, but I think the ARPUs should bottom out over the next quarter or two.
Okay. The other question would be on OMCs. Just before we get to Mayuresh on that, let's just hear out the oil minister making that statement about how oil marketing companies have not been asked to share the margins.
हमारी कंपनियां, हम लोगों ने सोच समझ के कंपनियों को बाजार भाव अपने ही तय करे, अंतर्राष्ट्रीय बाजार के आधारित पे तय करे, ये सरकार की सोची समझी रणनीति है। क्योंकि हम अगर ज़्यादा प्रतियोगिताओं को नहीं करेंगे, कंपटीटर को नहीं लाएंगे, ये लॉन्ग टर्म पे ये समाधान नहीं देगी। इसलिए इस विषय पे सरकार ने स्वतंत्रता दिया है कंपनियों को। सरकार की कोई निर्देश कंपनियों के लिए नहीं है।
Okay, that's the oil minister confirming that news that no communication from the government side has been done to the oil marketing companies to absorb any sort of prices. Mayuresh, if I could come to you and take your view on the oil marketing companies which had corrected sharply in yesterday's session, and today post that clarification from the oil minister, there seems to be some bit of recovery there.
Oh, absolutely. And again, I think the overhang for these stocks is probably going to be state elections looming around the corner over the next few months. So how much of an impact that can have, and any shift if crude stays above that $70-72 a mark is going to create a dent in terms of the sensitivity to earnings for OMCs. Again, the government's propensity to probably not take a hit on their balance sheet on what they have provided for in this budget will obviously get passed through. So what happens is either the upstream or the downstream in proportions that they used to share earlier might be asked to share. So I think those are some of the risk factors that the market is perceiving for oil marketing companies. But again, one must probably understand that whatever you've seen over the past few weeks and quarters in terms of the OPEC cuts and where prices are at this point of time, you're probably going to see more drawdowns happening from the US inventories. So as shale production starts moving up higher, you're probably going to see oil prices stabilize. So on an annualized basis, I think a large consensus, or at least our consensus, is that oil should probably gyrate in the range between $60 and $68, which is as per both the government and RBI's outlook for the entire fiscal. If that probably happens, the fiscal maths from an India macro perspective probably gets worsened a tad bit. But for oil marketing companies, generally, I think the new complexities that are coming through, the high distillate yields that these new complexities can throw out in terms of gross refining margins, as well as their product slate and the optimization thereof, is going to create a huge impetus in terms of cash flows. So I'm not overly perturbed at this point of time. There might be a short-term impact both in terms of earnings as well as stock prices. But I think the longer term, with the assumption of oil prices and rupee not depreciating significantly against the dollar, still works in favor of oil marketing companies in terms of earnings. So the decline in stocks probably factors that in. any significant decline in a stock like IOC is still where my belief and conviction lies because of its diversified business model.
Okay. Stay on, Mayuresh. Lots more to talk about. Request our experts to stay on as well. Just a couple of quick editorial pieces. Firstly, a list of stocks that could enter or come out of the F&O ban. Somehow the list does not look like a list of late, Navneet. Maybe a stock or two here and there. What's it looking like today?
Well, Neeraj, just one stock that could enter into the F&O ban for tomorrow's session, and that's IRB Infra. Remember, this was the stock which was quite active in yesterday's session. It touched its 52-week high, and today some bit of cool-off was seen for this one. It's trading with cuts of 3%. If you look at the total open interest as of yesterday, and as a percentage of market-wide position limit was nearly 89%. For the stock to enter into the F&O ban, it has to breach the 95% mark, and today's data points do suggest that it could just breach the 95% mark. There's been additions seen for the future and also for a couple of option strikes. But just a caveat here, the trends do change in the last 10 to 15 minutes of trade.
Okay, we'll watch out for those. Thanks a lot for that, Navneet. On to what dealing rooms are recommending in the session today. And Darshan Mehta and Yatin Mota join in with their channel checks. Gentlemen, both of you, good afternoon. Yatin, let's start off with you first.
Neeraj, a couple of stocks and, starting with JSW Steel. There was a news report today morning which said that the domestic billet prices have risen, and not only that, on an overall basis, we have seen the input costs for steel producers moving higher. So in that scenario, dealers are recommending a short on select steel companies, given the fact that the raw material costs are moving higher, and probably that will translate into some bit of margin pressure moving forward. So JSW Steel is one stock wherein dealers are recommending a positional stock, and they expect a 5 to 7% downside here. Apart from that, two stocks to watch out for, Infosys and TCS. We have these IT majors, and they will be coming out with their earnings very, very shortly. Dealers see a 5 to 7% trading upside as far as both of these IT names are concerned. And finally, watch out for Camlin Fine in the cash market segment. This mid-cap saw some large block deals happen in trade today on the back of HNI buying, which is currently on in the stock. So, dealers expect some more action as far as this stock is concerned. But Darshan has a few more stocks to talk about.
Yeah, so one of the stocks that's been rather active, I think the tire space is doing extremely well. One of the stocks that's very, very active in trade today is Apollo Tyres. Obviously, the management spoke to us, gave a very positive commentary. But a couple of things that work in Apollo Tyres. First of all, if you look at the insider trader information that comes in on the exchange, and we report it every day, you've seen that the promoter entity is constantly accumulating shares of itself. So that's one of the positive trends. But on the F&O side, on the technical side also looks good, and rubber prices have come off significantly, so that bodes well. So some of the dealers have given these reasons why they like Apollo Tyres. The next stock that is being spoken about is First Source Solution. Stock is trading at a fresh 52-week high. In fact, it's at a 10-year high today. It's doing extremely well, and some of the counters which are at 52-week high, the traction seems to be there as a momentum play. First Source Solutions being spoken about. And the other last stock that dealers are talking about is Gujarat Alkalis. It's not up very sharply in trade. It's just up 1%. But some of the HNIs have actually accumulated. The volumes are also decent. So that's what dealers are talking about in trade today.
Interesting. Thanks a lot for that. Gujarat Alkalis, and this and a few other names. Jay, come in here. I mean, for the longest time, I've heard you speak about this company called Daiichi Karkarya. These alkali specialty chemical companies. I don't know if you've looked at Gujarat Alkalis, for example, but some of the other names have been very, very robust. Nosil has had a fabulous run too. Navin Fluorine and SRF, the erstwhile guys, and SRF has been nudging new highs. Anything in this pocket?
I still continue to maintain the view on Daiichi. But it's just languishing a bit. I'm sure that's going to come off. But I haven't looked at Gujarat Alkali, but I have recently, so that I'm not able to have a price projection for this. But Daiichi, I maintain the same price objective of about 700 plus, and it's likely to do pretty well. And within this space, I'm still positive on Philips Carbon Black, but it's still got some more correction to do. Once that is done, I think it's going past the record highs it made. It's got a decent correction. It's got possibly another 5% downside to come. Once that is done, I think that it'll scale back to record highs.
Okay. By the way, while we're talking about all the gainers, I need to take a look at the losers as well. Sugar has continued to slide lower. Remember, the prices have come off quite considerably. Balrampur Chini is the second top loser on the NSE 500, down about 5%. I doubt some of the others would be faring okay. So the likes of Bajaj, Hindustan, Sakti, etc. should be down. Dwarikesh is down about 4% as well. Dhampur 8.5%. So the sugar space is certainly under problem. I think the prices are sub 2,700. From 3,200 to 2,700, there's been a sharp gash of over 15% in the sugar prices. So no surprise there that the companies and the stocks are reeling under extreme pressure right now. Rahul, either that, but if these are not too trader friendly, then maybe Adani Enterprises, which is certainly liquid and the top loser on the NSE 500.
Yeah, if you look at the stock has been moving in a sideways just above its 200-day moving average, and it was facing resistance around its 100-day moving average, which was the level was around 155. So currently, looking at the setup, I feel that again stock can drift down to the levels of 125, which is the major support range. And if it sustains below that, then it could inch back to the levels of further more downside to 115. But at current levels, I think that one should wait for stock to close just below its 200-day moving average, which is just below its 130 levels. So definitely the momentum is weak, but now I will wait for the stock to close below 130. Then we could see extension of downside till the levels of 125 to 120 in short to medium term.
Okay, let's get in closing strategies. Then last 10 minutes of trade left, and Jay, I'll come to you first. Your top closing strategy today. It could be a BTST, it could be an STBT, it could be an index trade as well.
Yeah, I'm tossing between two groups, basically the Ramco group and the TVS group. All the stocks within this these two groups are looking pretty good, and given that Ramco Siemens is doing pretty well and it's very close to the 52-week highs, I think it's got a good potential to once scale past the 52-week high. I think it'll just blow through. That presents a very good BTST point today. So I'll go for Ramco Siemens at this point of time.
Okay, Rahul, what about you? Your top closing strategy?
Yeah, looking at the momentum in the IT stock, I'm liking KPIT. It is a positional call. One can buy at current levels with a stop loss of 214. Upside target short to medium term would be 235.
Okay. Jai Bala, take a moment to thank you. I understand we have to let you go, but much appreciate you taking the time out and being with us today on Bloomberg Quint. It's been a while that we had you, Jai. A lot of people were asking about when would we have you next. So glad that we spoke today, but look forward to have you more often on this forum.
Yeah, thank you. Thank you for having me.
All right, that's the view from Jai Bala. Okay, Mayuresh, before we talk about your stock recommendation, a word on somebody who is holding on to sugar names. The price damage has been very, very strong and quite steep and quite swift. Is it too late to sell now?
I think you should get out of this cycle. I think we did discuss this a few weeks back. And looking at the production estimates that are preliminarily coming through, I think you're probably looking at 30 million tons of production. Now what you're probably looking in terms of demand of 24.5 million tons plus the carryover stock that has come from the last sugar season. I think you're probably going to 3 excesses in the domestic market. And even if export markets are opened up, I think a few quotas in neighboring countries like Pakistan have also opened up significantly. So to that bit, the pricing in international sugar markets is also expected to be far lower. In terms of realizations and the numbers that you're probably putting through, I think obviously realizations at farm gate prices are far, far lower than what these companies had enjoyed in the 2-year cycle. So a sugar cycle typically is a 2-year on-off cycle. I think the 2-year cycle, which is the best cycle for the sugar companies with lower production and stable demand, is far behind them. So the 2-year off cycle has probably begun for sugar industry as a whole. And with that respect, again, I think sugar companies' operating parameters, at least for the next 4 to 6 quarters, will not see any significant improvement. So yes, I think if investors are still into the sugar stock, they probably should get out, look at some other sectors at this point of time.
Mayuresh, moving away from sugar, I think you're bullish on LT Foods. What's making you bullish there? There are other rice companies as well where we've seen good moves coming in the last 1 year from the likes of KRBL and the others. What is so special about LT Foods?
So I think we're moving from one commodity to the other. So sugar is something that I don't like, but rice is something where my belief is that the volume numbers should be pretty well. And we actually did a comparative stacking of LT Foods along with all its peers. And the interesting aspect that actually came through is the volume growth for LT Foods historically and on an annualized basis going forward on our assumptions looks pretty stable and looks pretty decent compared to the others. The second element in terms of their export business, which garners 55% of their overall revenues, and with the Iran shipments and the European shipments that have opened up in the past few quarters and weeks, I think that does give it impetus in terms to how the volume growth for this company will be. Now, the brands are quite well known. So Dawat, you're probably looking at Royal in the North American markets, are doing pretty well in terms of both brand reach as well as visibility. In terms of the domestic reach itself, they've got 1,40,000 retail outlets. You're probably looking at catering of the products in towns in excess of 2 odd lakhs, of almost 93% coverage being done, and you're probably looking at 3,000 odd wholesalers. So I think the distribution network is pretty robust as well. The capital raising that they did of almost 400 odd crores, I think 180 crores will go into debt repayment, which means that the debt, which stood at around 2.2, 2.3 odd times FY17, should come down substantially. And the realizations, again, I think when you're talking about the Pusa 1121 variety, which is one of the most premium varieties of basmati rice, and the demand outlook thereof is very, very robust, specifically in the Western world, you're probably going to see realization growth probably remaining stable and improving here on. So I think operating margins of around 11.5 to 12%, top line growth of 14%, bottom line growth of 20% should lead to a very strong earnings momentum. So yes, we did do the stacking with a comparative analysis basis with peers. What we probably found out is that the volume growth, along with realization growth and earnings growth, appears to be far better for LT Foods over the longer run.
Interesting. Okay, Mayuresh, stay on. We'll take in one final thought from you as well. But just before we start wrapping up the markets, and the index has inched up a bit, by the way. The Sensex is up about 0.5% now. But the one spot which is losing out today, Rahul, Randeria, are the metal names, the base metal names in particular. For people who had some long positions for the last couple of days and are still carrying on or holding on to the long positions, what would your advice be?
Yeah, if you look at the metal space, Hindalco, Vedanta, and all the different other stocks, I'm liking Hindalco as well as Vedanta. Hindalco has already rallied, so I will wait for some cool off to enter into at the lower levels. But if you look at Vedanta, after a correction from the levels of 355, a stock just made a bottom around 270. After that, it has gone into a triangular consolidation. Yesterday, we have seen a breakout, and currently the stock has potential to test the gap area, which is just around 307 rupees. So definitely at current levels, for day trading, it could be difficult. But yes, for short to medium term, the triangular pattern breakout has potential to test the levels of 307 on the upside. So definitely at current levels to 285, one can buy, with a stop loss below maybe 277 for a target of 307 on the upside for in maybe next 20 to 15 days.
Okay, that's the view coming in on the metal space. Vedanta, according to Rahul, can still be bought at current levels. Rahul, one more stock I wanted to check on, Pidilite. It's gone up nearly 2% in trade. And I don't know, there was some action seen in this stock in the recent past where it's become very active. Any trends that you're seeing on the charts?
Yeah, if you look at Pidilite, the stock has given a rounding bottom formation breakout a couple of days back. But yesterday's pattern, if you look at it, was an engulfing bearish pattern. And today again, the stock is inching back on the higher levels. So last 3 days have been highly volatile in the stock. We have seen ups and downs in a very short span of time. I will wait for stocks to just close above maybe 1015. If it breaks those levels, then again stock can test the levels of 1100 in short to medium term. So those who are holding long positions in last couple of days can hold on with a stop loss of 990 on the downside. And once it sustains about 1015, then again it can inch back to the levels of 1100, and one can book profit at those levels because stock has rallied significantly in the last 10 to 15 trading sessions.
Okay, that's a hold on Pidilite if anyone's bought. It's crossed the 1,000 mark in today's session, and also it's inching very closer to its 52-week high of somewhere about 1,014 or 15. But for the markets as well, we're inching very closer to the day's high mark of 10,469, which we've seen today. Just few minutes for markets to close. Let's head across to Neeraj to find out how exactly today's closing is panning out. And Neeraj, not bad at all. I think we picked up momentum in the second half of the session.
Yeah, I'm wondering for how many days will this streak last, because it's been, what, 5 or 6 or maybe 7 odd days that we've had the indices ending in the green, which is actually a pretty good thing. And similar to trade yesterday, where in the second half, in the late trade, we picked up steam. That's exactly what's happened. It's happened since the participation of the Nifty Bank. I mean, Nifty Bank has not really led the rally predominantly because it's IT stocks. But just want to bring up the mid caps and the small caps once, which were trading very flat. In fact, the small cap index is ending lower. The mid caps trading very flat. So it's been very concentrated in select large cap names. And I think that's what you will see on the index gainers as well. So TCS, Infosys, and then of course HCL Tech, Mahindra, etc. All of them on the Nifty too have gained. And private banks selectively, the likes of Axis and ICICI Bank and HDFC Bank, not correcting. So two heavyweight sectors, one doing extremely well, the other not doing poorly, aiding the sentiment in the rally today. Not too many losers, not too many big losers, let me put it that way. Let me qualify myself. DRL marginally off. Some metal names, Tata Steel, Vedanta, Hindalco. So base metals, ferrous, non-ferrous, both of them had a bit of a stick today. But by and large, the losers didn't really make too much of a dramatic impact, and which is why we have a 0.5% uptick on the benchmark indices, but not such a great day for the small caps in particular. Maybe it is showing in the market breadth as well, Navneet, that the large caps did reasonably well. The mid caps and the small caps, well, a bit of a disappointment.
That's right, Neeraj. Even the gains were quite capped in today's session if you look at the broader markets. But let me start off with stocks like Zenith Exports, which was locked in upper circuit with gains of 20%. And this is the second straight day of the circuit that we've seen for this one. Orissa Mineral Development, that got some leases, so on back of which you saw that gain coming in of almost 10%. Dish TV, we spoke about this counter at length in today's session, and the reason why it went up 6 to 7% is due to offer for sale, which came in by the promoters at about 74 rupees, but the stock's closing way above that mark of 74. It's also crossed its 200-day moving average today. Havells is the other one, which was one of the gainers on the futures and options side as well. So 3% higher for Havells. The entire IT pack, remember, that gave support to the markets, that propelled the markets higher. So from the mid-cap IT pack, you had something like NIT Tech and Tata Elxsi. Both of them saw good gains of between 2 to 3%. Apollo Tyres from the tire pack, remember the tire stocks have been active. We also spoke to the management today, but they did indicate that the margins once again could be under pressure in the fourth quarter. But the stock definitely has been doing pretty well. It's at around 52-week high, 2.5% higher for that one. On the losing side, Adani Enterprises, your top F&O loser also for the day, down almost 6% in trade, 5% towards the closing session. Sugar stocks were weak. Balrampur Chini, Dhampur Sugar, both of them saw cuts, and some profit booking coming in from the metal space. So Steel Authority was the one which saw cuts of nearly 3.5% to almost 4% in today's session, Neeraj.
Well, so all in all, let's pull up the benchmark indices, or firstly the intraday of the index and then the heat map as well will come up on your screen. So ending fairly okay for the Nifty, and the heat map will show you that there's a fair sprinkling of red, which got, the green just tried to claw its way back towards the second half of trade. The contributors list, and you'll probably see IT names right up there, but select banking names could also be there on the winning side. Yeah, so HDFC from the NBFC space doing okay. Otherwise, it's all IT. When was the last time I saw this? I don't even remember, honestly, that it was IT names which are dominating trade, Navneet. And you were talking about how this was visible even in the trading patterns on the F&O side as well.
Yeah, as I mentioned, a lot of the guests on the show have been saying, in fact, we did get a call on Nifty IT yesterday's session. It's very rare to get a long call on Nifty IT when we ask our analyst about Nifty or Bank Nifty. For a change, Amit Shah, BOB Capital highlighted he would go long on Nifty IT. Instead, it's a tricky call, Neeraj, ahead of Infi earnings, because you never know what sort of earnings come out tomorrow.
Yeah, it's very, very interesting. Not too many losers, as we said. Hardly any notable contributors. And the turnover should come up on your screen. Remember, it was Thursday, and which is the F&O turnover fairly high. The cash market turnover not so. But honestly, didn't see too much of volatility at all. I don't know if, maybe on the option prices, etc., it would have been. But nothing, almost zero impact that we saw in the way the banking stocks were trading today.
You're right, actually, because this sort of bounce back Bank Nifty saw in the last, 6 to 7 trading sessions, we've already bounced back 1,000 points. So just in the last week also, if you see, Neeraj, from Thursday to this Thursday, I think it's been a gain of 1 to 1.5%. So the short covering, which the analysts have been saying, it's already priced in. And I think most of the people on the street are not so bullish now in Bank Nifty. According to them, the rally of 1,000 points have already priced in everything. It remains to be seen whether we can propel higher from these levels of 25,000 or not.
Well, let's wait and watch. So that's the analysis for the day's trade. Final thoughts from our experts. Mayuresh, I'll come to you first. What do you expect the big boy to do tomorrow? And should INFI give a guidance in line with what people anticipate? Can that be an extension of the move that we've had today?
No, so to a large element, Neeraj, in terms of expectations of guidance, it's largely factoring in 6 to 8% constant currency guidance growth with EBITDA margins between 24 and 25 odd percent. Now, for the quarter, I think the growth can be extremely strong in dollar terms to the tune of 2% on a quarter-on-quarter basis with volume growth of around 0.2, 0.3 percentage points. But a large element will be in terms of management commentary, specifically towards their key subsegments, and within that, again, that's going to be BFSI. So again, a substantial chunk comes through this segment. What actually happens in terms of the US tax reforms and what kind of an implied impact it has on discretionary spending by these companies is going to be critical. The third element obviously is going to be the digital deal wins. So the TCVs, as the IT parlance calls it, is going to be extremely critical for Infosys, both in terms of understanding its order backlog, the utilization levels, and again, I think managing the attrition levels under the new management. So large element on the fourth aspect of capital allocation and what probably happens in terms of dividend payouts. If any announcements done on that part, I think that's going to be very interesting as well. From a valuation perspective, I think it's fairly priced at this point of time with these assumptions for FY19, FY20. So any of these assumptions, I think, which come on the lower side might disappoint if it's more or less in line with expectations and the management commentary is reasonable. I think you might see a reasonable uptick, but a large gestation in terms of the price movement, specifically in terms of management commentary. And what probably happens in terms of guidance, in my opinion, is in the price. So anything adverse, probably you might see a sharp sell-off, but I think it should be more or less in line with what the street estimates.
Well, Mayuresh, that's going to be a big number, and probably
Monday is too far off, no?
Going to set the tone for the entire IT pack as well. Thanks a lot, Mayuresh, for joining us today and taking us through your thoughts on the markets. Rahul, before we let you go, what's going to be the approach tomorrow? And it could be volatile. You know, we've seen how INFI numbers have been volatile at times, and that sets the mood for the market, considering it's also a heavy weight. And if the other IT stocks also move in the same direction, like TCS and HCL, what should be the approach? Would you stick to Nifty, Bank Nifty, or Nifty IB?
Yeah, if you look at the daily charts of Nifty as well as Bank Nifty, a couple of days back, maybe 8, 9, 10 days back, we have seen a breakout from a downward falling wedge, and that is the reason why we have seen a sharp rally. Now looking at the last couple of days of intraday charts, both on Nifty as well as Bank Nifty, the pattern in which it is going up, it is consolidating for 3-4 hours and again moving 40-50, maybe 0.5% on the upside on both the indices. This has been a pattern followed in the last couple of days. Looking at the closing, I feel that again, as we said earlier, that Nifty has potential to test the levels of 10,478, which was its previous swing high, and if it sustains about those levels, then it can inch back to the levels of 10,560, which was the gap area, as well as it is a 50% retracement mark. In Bank Nifty, on the upside, it can test the levels of 25,400, and above that, the 50% retracement market 25,600. So definitely, with a trailing stop loss of just below 25,000 in Bank Nifty, one can go long. The stop loss should be very strict, and in Nifty, again, one can go long with the stop loss just below 10,380 odd levels. So definitely for positional basis, it is looking good, but one has to be cautiously bullish, as we have seen, a sharp rally in the last 10 to 11 trading sessions. So one should keep on going long with keeping on trailing stop loss at the higher levels.
Okay, that's the view coming in on Bank Nifty. Remember, Nifty today closed above its 100-day moving average. It was the resistance mark that everybody was talking about, but towards the end, it managed to close above that. Rahul, appreciate you joining us today and taking us through your technical ideas. And with that, it's a wrap on this edition of Countdown. Don't go anywhere. Up next, we wrap the day's trading session for you on Bloomberg Quint Market Wrap. Stay tuned.